Okay, I'm going to go over this comparing tax situations with you. And this is over, we're going to look at what tax deductions, personal exemptions, and tax credits are. So it says taxpayers can use certain items to reduce their taxable income. They can also subtract certain items from the taxes they owe. Looking at the chart down below. So basically what happens is you look at how much money you made in the year before. Your goal is to get your taxable income as low as possible, because that's the number that they are going to use to calculate the percentage of taxes that you owe. And we know that the federal income tax is a progressive tax, which means the more your income level is, the higher percentage that you're going to pay. So the goal is to get this income as low as possible so that you can get yourself in as low a tax bracket as possible. So you have what's called deductions, exemptions, and we're going to look at tax credits. And so we're going to calculate what your taxable income is, how much you have to pay, and then your total taxes at the end here. So tax deductions reduce your taxable income. Some will take a standard deduction, and that just means when you add up all of the deductions that you have kept track of, all of the things that you're allowed to deduct didn't add up to more than $5,450. So if you keep all of your receipts for the year and your tax deductions end up being more than this, then you're going to use and you're going to itemize that. You're going to turn over your receipts to the government, and you're going to say these are all the things that I purchased and it was more than that. If the receipts add up to less than this, let's say all your receipts add up to $3,000, then you're going to use the standard deduction. You're going to use whichever number is largest, because you get to take that number and subtract it from your income that you made that year. So this standard deduction for this problem is $5,450. Personal exemptions. So this is based on how many people are in your family. So if you only have one person that you are responsible for, your exemption is going to be $3,500. If you're married, this number gets bigger. If you have children, these numbers get bigger. And then taxpayer credits you get for some items. And typically it's something that the government really, really wants you to do. And so I know there's been interest in giving people huge tax credits for buying electric vehicles. The government is trying to encourage and incentivize people to do that, so they're going to give you a tax credit for that. So we're looking at these three people down here, Doreen, Sanja, and Ben. They all three have the same income, but based on their different circumstances, what they're going to end up paying in total taxes, the end is going to be very different. So Doreen has no special circumstances. She can't, excuse me, she doesn't have any deductions like healthcare expense, charity, moving expenses. Teachers sometimes can get paid for their expenses or some of their expenses. If you have a home loan, you can write off interest for your home loan, also known as a mortgage. If you have property taxes, all of that stuff can go in as a deduction. So she didn't have enough deductions, so she's using the standard deduction of $5,450. Since there's only one person, it said her personal exemption, she's single, so she gets to subtract the $3,500. So this was her income. She gets to take off the deduction, the standard deduction, and then the exemption for her for herself. So her taxable income is lowered to $27,450. You look that up on the tax table. She owes $3,716. She didn't buy anything or do anything that gives her any tax credit, so her total tax bill is $3,716. Sanja, on the other hand, has a house that she has a mortgage on, so she pays a home loan. Her interest was $5,500. Her property tax is $1,000. So when you add up these two numbers, $5,500 and $1,000, that is $6,500. So that is larger than what the standard deduction is. So she is going to use that as her deduction. Gets to count herself, so her exemption is $3,500. which means her taxable income is $26,400. And so she's paying on a smaller amount, so her tax bill is going to be less. She owes $3,559. Ben doesn't have any deductions, so he's going to use the standard deduction. He's going to also use his exemption. So his taxable income is going to be the same as Doreen's. So he owes $3,716. But what you notice is that he gets a tax credit of $1,050 for buying the hybrid. So we deduct that whole entire amount from the amount that he owes. So he only has to pay the $2,666. And so I wrote me some notes over here. Deductions lower taxable income. Tax credit is subtracted from the tax owed. So really the tax credit is much more beneficial to you, but obviously they're giving you a $1,050 tax credit for buying a car. So, your car payment and the car is going to be a lot more expensive than that, but still, if you're in the market and you do that, then good for you. So how much were Sandra's itemized deductions than the standard deduction, and how did her deductions affect our taxes, and how can you tell? So since the standard deduction was $5,450 and she had $6,500 in mortgage interest and property taxes, she was able to lower her taxable income by that $1,050, the difference between the standard deduction and the amount that she could use to itemize. How did Ben's tax credit affect his taxes, and how can you tell? It lowered the total tax that he owed. He would have had to pay this $3,116, but because he had this tax credit, he was able to lower it down to $2,666. And so which is better for the taxpayer? If we're just talking dollars here, then obviously a tax credit, because it subtracts from the actual amount that you owe, and it doesn't just reduce the amount that you're going to be taxed on.